Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Okay, the closing counts on Wall Street. Let's reiterate here. The techs had a bit of a nasty day there. Look at that, 1.25% down for the NASDAQ. But hey, old line is sexy today. Dow Jones up 103 in the green. Tom White, TD Ameritrade, joins us from Chicago. Tom, what do you think of this notion that maybe Amazon isn't going to kill everybody else in the U.S. economy? I mean, you need transport, you need the delivery people, you need a lot of people on Jeff Bezos and Amazon's side.
Yeah, I think what you're seeing here out of Amazon is probably less news. They're coming out with maybe less sectors that they might rotate into. They're already hurting the retail, the brick and mortar retail sector. We've seen that. If they get into the pharmaceutical consumer delivery business, they're going to start to hurt that. But I think just less rhetoric as they focus on the holiday sales season has kind of put everybody back in play. But the rotation out of tech today was pretty strong. But after roughly a 32% gain in the NASDAQ so far this year, it wasn't surprising to see some investors taking some money off the table at this point.
Right, Tom, and there was some redistribution, at least today, from some of the FANG plays into things that might benefit from, you know, whatever tax reform, maybe slightly higher interest rates, maybe less regulation. I mean, it's not as sexy a story, you know, as an Amazon or a Netflix. But you know, these are the old standbys, the old pillars of the economy. They haven't gone away.
No, yeah, we've got the Dow, we got the blue chips up basically 21% so far this year. And what we've seen over the last couple of days here, Bernie, is a nice rotation into these small cap stocks. The Russell 2000 had been underperforming the overall market by anywhere from 30% to 80% in some of the major indices. And what we're seeing is with the tax reform plan, the vote scheduled for tomorrow, with that, it's going to help domestic companies, those small to mid-cap companies that make up the Russell. And what we're seeing is a nice rotation into those. It's up nearly 2% over the last two sessions, and the Dow Industrials were up again strongly today on the back of some rotation into those blue chip dividend paying names, even with one of its biggest components, Apple, down a couple percent. So you know, investors are being keen here to take some profits in specific sectors that have worked out well for them, and then moving into maybe beaten down sectors or sectors that'll be able to take advantage of some tax reform and maybe you know, get some cash into their coffers into the end of the year here.
Yeah, Tom, that seems to be an element that the market hasn't directly dealt with head on. I mean, you know, in committee, Ron Johnson of Wisconsin is okay with the tax bill. He was the one that was harping about overly generous treatment for C-class corporations versus pass-throughs. Something must have happened. There must be something for the smaller businesses to have gotten Senator Johnson to sign on to it. So when you talk about the Russell 2000, when we talk about the Wilshire indexes, do you think that's going to be the next? Do you think that's going to be the next fishing spot in the market?
I think so. If we're going to continue this rally that we've seen so far this year, I think it's going to be led by those small cap companies. If you know, Senator Johnson was one of those that was opposing this, they just had some negotiations, I guess, that took place today, where they're going to raise some of the interest deduction on those pass-through companies up to 20%. Some of the other members wanted it up to 25%. So that's going to help them as far as the vote goes. They did have some key notes that just came out recently where they're going to start this deliberation for the next 20 hours on this the Senate bill, and then they'll have the vote hopefully before Friday. But you know what? I think the Republicans are working as one unit to try to get this through, and if they get less than that majority, that they have 52 members in Senate, if more than 2 of those members fall out, we're not going to see this thing pass. So I think everybody's trying to get on board, and they're trying to make the right concessions, which are going to help those small cap companies, and those could be the leaders into the end of the year.
All right, Tom, let me go way off the deep end here and ask you about Bitcoin. Would this make a great stocking stuffer? The way it's been moving up, it's going to be 100,000 by Christmas.
Yeah, we've had a lot of discussions about Bitcoin. We've got some of the futures markets over here next month in December are going to start trading Bitcoin. So we've seen some outlier companies that are involved in the Bitcoin and the cryptocurrency and the blockchain technologies really start to become a lot more volatile as people are looking at this space. They see it in the news. They see it on magazine covers. They want to be involved. What we're trying to explain to investors is that be cautious with this. If you have some money to speculate with and you want to take a risk-defined type of position in something like this, you could maybe do that. What we saw was into that weekend after Thanksgiving is 100,000 new accounts opened up at that exchange Coinbase. Yeah. So the interest in Bitcoin is driving it up. It hit the 11,000 mark today, dropped 18% intraday. Before finishing about 10,000. So we've seen some added volatility in there. So, we always tell investors, you better wear your big boy trading pants if you're going to be involved in a product like that.
I don't know. I think gold ingots are a bargain compared to Bitcoin. Tom, you have a good one, okay? Have happy holidays. Tom White, TD Ameritrade, Chicago. We're going for a break. We're back with a quick look at the markets on Squawk before we get to the bottom of the hour. Cupertino Apple has filed a counter lawsuit against Qualcomm's Snapdragon mobile phone chip, alleging a patent infringement. It is the latest volley in a back and forth, number of them between the two names. However, QCOM, which hails originally from Illinois, also faces a U.S. Federal Trade Commission, or FTC, lawsuit over many of the same complaints that Apple is making. So I guess this is one of those things, anytime you've got something in tech and telecoms, the lawyers will be hovering. And we talked about this with Tom a second ago. Bitcoin falling a little bit back below 10K after it zoomed past 11,000 to a breathtaking record high for a sixth consecutive session. That was a $1,000 gain in the space of just 12 hours. I don't know if you caught this, but if you do a little more reading into Bitcoin, there are some that say that at the ultimate, if you take all the paper currencies in the world, those will be worth in the neighborhood of $8 trillion. And if you say that Bitcoin is worth paper currencies, which can be debased by central banks, you're talking about 300,000 per Bitcoin. That's one valuation method. Coming up, you can now have breakfast at Tiffany's. Literally, the jewelry maker, famous for their blue box, opened a cafe called the Blue Box Cafe. We'll tell you all about it.
It's half past the hour. We are 30 minutes away from the open in Tokyo. We have records coming through from the Dow, a triple-digit gain there. We got the implied open at 22,660 for the Nikkei and the dollar-yen at 112.02. Bernie.
You know, now that we're getting into the Christmas shopping season, who's famous for the powder baby blue box?
Of course, Tiffany. How can you not know that?
I knew that. I thought it was a baby boomer thing. I didn't think that you'd remember, especially since they were made famous back in the 60s. Indeed, folks, Tiffany and Company posting a sixth consecutive quarter of positive results in the overnight. The jewelry maker beating expectations and also reporting improved margins as well. Asia Pacific sales a bright spot. The stock a little bit soft. Sales out of Europe and North America backtracked a little bit. Earlier in the month, Tiffany gave fans a treat by opening a Blue Box Cafe at their flagship Manhattan store, so customers can actually, for a change, really have breakfast at Tiffany's. Well, more like brunch because they don't open until 10 a.m. But anyway, many are still queuing up, some overnight, for a chance to channel the iconic 1961 Audrey Hepburn film, all part of the brand's turnaround strategy under their relatively new CEO. David Chick is lead retail analyst and director of research at Consumer Edge Research and joins us from D.C. David, good evening to you, and thank you very much for joining us. You know, the new chief executive, Alejandro Bolillo, has been trying new things, trying to bring the millennials into the store, to a brand they might not be familiar with, by offering lower-priced diffusion brands, silver alloy lines, that sort of thing. Is it working?
I think the earliest signs are a lot of newness in November is working. Something we talked about today post-earnings. If you look at digital searches for Tiffany, November, this month, is the biggest increase we've seen in 5 years. And it was never supposed to help last quarter. The new catalog for gifts started in November. You just talked about the cafe. The buzz is growing. That takes time to translate into business, but there are signs that it's starting to work. Right.
Do you have a strong sense, David, that it's actually going to translate into into top-line accretion? I mean, or is it just curiosity, something that maybe a lot of these millennials, mothers and fathers were more familiar with?
Sure. Well, you have to stay relevant, and it doesn't happen right away. But if you look at the quarter they reported today, the better quarter, some of that was revenue upside on a 2-year stack, taking some of the noise out of the numbers. Business got better. Now, it's far behind where it should be from some of the luxury peers, but we think that really came from this lack of newness that's persisted over, say, the last 5 years. If you think about what's driving consumers, it's about experiences over things, but things can be part of it as long as they're experiential. You said an iconic brand, there's heritage there. Tiffany really does stand for something in the market, but it has to be fun, it has to be new, it has to get people's attention. I think the gift catalog, you know, for years they had a crystal and fine china gifting business and homeware business, and that customer might become, and often did become, a jewelry customer. I think the gifts are part of trying to capture some of that holistic thinking back. The cafe, as you mentioned, is part of getting people excited about the brand. It's not going to happen real time, but there are signs it's starting to drive the top line of the business.
Right. David, I remember, you know, decades ago when I first became a Tiffany customer, and I have to admit, you know, they got the high-end stuff, but they've also got silver jewelry, which was much more affordable, you know, to a 20, 30-something at that time. And I, you know, thank my lucky stars that I was able to do something at Tiffany's. The fact that they're actually going silver alloy now, does that diffuse the brand, or is that totally okay with the consumer? Is that going to put off any of its core consumer base?
Well, yeah, it's a great question. I think there's a mix and a balance, of course. So one of the things Tiffany has done over the years, you know, they've certainly kept newness fairly low as a percentage of their portfolio products relative to peers. Something else, they've moved away at various times over the last couple decades from silver, from what you're talking about, the more accessible gifts. In fact, you know, years ago they felt that there were too many Tiffany keychains out there, in a sense, the low price gifts. And moving away from that opens them up to losing relevance to younger folks. Now, they're going to try a number of different things here. If you look at the gifting catalog that's out in November, you know, there's a paper cup looking China cup, but there's a $650 leather ping pong paddle as well with that Tiffany blue. So you're seeing, you know, new price points, new offerings to try to bring different people in. I think that, you know, if anything, a lack of newness and walking away from some of that entry-level business purposefully has probably hurt them. And I think you're seeing their attempts now to capture that back.
I got to check out those ping pong paddles. That's something I could use for the next 20 or 30 years, David. David, one of the pleasures that way back then in history was actually being able to go into a Tiffany store, you know, and actually do a transaction and feel like I had arrived or something, and getting some level of respect from the counter staff. But nowadays, you know, it's the Amazon age. Do people want to be able to, you know, do things and buy things like Tiffany offers alongside the cheapest cubic zirconias they can find online, or does Tiffany maintain that offline aura? So
you're right, but omni-channel works. So it's really both is the answer. You've got to have an in-store experience that, in luxury's case, keeps the experience with the brand special and meaningful and different. And at the same time, you've got to make yourself easy to shop and accessible. I think the easy to shop and accessible is partly digital and partly product. You're seeing more of that. You've got to be bouncing around social media in two different ways, right? One is reviews of products, of new products. If you look back a couple weeks ago, there was an awful lot of social media mention of the new gifting catalog with those ping pong paddles that you've got your eye on. If you look at experiences, something like going to the Tiffany Cafe, that's going to have people mentioning it and that viral effect. This is the way consumers now define their. I'm sorry.
Yeah. No, that's you're right. Omni-channel. It's a little bit of this, a little bit of that. It's not mutually exclusive either. Or, David, you got 105 PT on the stock, but it trades at 10 times adjusted enterprise value over EBITDA, which is a little bit ahead of their peer group in your estimation. So the gains are limited, right? The upside or any potential is limited?
Well, we've been overweight this year. It reached our target here today, our prior target, and we raised our target because we think there's some building momentum again in that 2-year stack, and that's on top of something we didn't mention before. There's a little more cost control showing up in this number as well. So it's part of that earnings beat was on the top line, part was on some cost controls, some pension expenses that they've cleaned up and minimized now through some payments last year, a little more procurement focus. So cost controls and a little more revenue momentum, and I think that's setting up, can potentially drive earnings output. If you look at what unique momentum brands have in luxury, low double digit on that multiple is not hard to see. So we think there's a little room on the multiple and a little room on numbers.
David, really appreciate your time today. Thank you, and have a good holiday yourself. David Schick, Consumer Edge Research, joining us from Washington, D.C. Right ahead, how do you solve a problem like North Korea? Well, the UN Security Council emergency meet is trying to do just that. Russia weighing in, calling on the South and the U.S. not to hold drills next month. Now, how's that going to help? Will calm heads prevail in New York? We shall find out.